Hi friends, in today's video, we are going to explore some of the most fascinating shifts happening in trading psychology and the stock market. We'll begin with Andrew Menaker's powerful idea of the inner market, where the biggest battle isn't on the charts, but inside our own mind. Then we'll see how social media is shaping new investors' decisions, often leading to both bold moves and painful regrets. Next, we'll dive into the booming world of trading psychology coaching, luxury retreats, and therapy, a billion-dollar industry built to help traders manage emotions and build resilience. We'll also look at how a new generation of investors is embracing the buy-the-dip strategy, shaping market resilience in their own unique way. And finally, we'll explore how social trading platforms create FOMO, pushing traders into comparisons and sometimes risky decisions. So stay tuned, because this journey will give you deep insights into how psychology, behavior, and mindset are driving today's markets. And as always, don't forget to like, share, and subscribe. Inner market, the hidden side of trading psychology. Most traders spend endless hours analyzing price charts, studying technical indicators, or following news updates. But very few pause to realize that there's another market, one that exists inside us, our inner market. This term, introduced by psychologist Andrew Menaker, explains that every trader carries within them an internal ecosystem of emotions, memories, beliefs, lifestyle habits, even their physical health. And this inner market quietly shapes every trading decision we make. Think about it for a moment. Two traders can look at the exact same chart, yet one pulls the trigger with confidence while the other hesitates and misses the opportunity. Why? It's not the chart that's different. It's their inner world. One trader might be calm, rested, and focused, while the other is tired, stressed, or carrying the weight of past losses. The chart didn't change, but the inner market did. Now here's the truth. In trading, self-awareness is as important as market knowledge. You could master every pattern, every strategy, and still fail if your emotions are controlling your decisions. Fear, greed, regret, overconfidence, these are not random feelings. They are signals coming from your inner market, asking for attention. Let me give you a relatable example. Imagine you had a terrible day outside of trading. Maybe an argument with someone close, maybe financial stress from personal expenses. You sit down at your screen telling yourself, I'll just trade normally. But deep down, your mind is clouded. That inner tension leaks into your trades. You either enter too early, exit too soon, or chase setups that don't even fit your plan. The outside market didn't sabotage you. Your inner market did. And this is why traders who succeed long-term don't just train their eyes, they train their minds. They develop the ability to regulate emotions, to step back when their inner market feels unstable, and to know themselves at a deeper level. So how can we manage this inner market? It begins with self-awareness. Before entering a trade, ask yourself, how am I feeling right now? Calm? Anxious? Tired? Overexcited? This simple pause helps you catch emotional states before they spill into your decisions. Next is emotional regulation. This doesn't mean suppressing your feelings. It means learning to ride the wave without letting it drown you. Breathing techniques, journaling, even short breaks can reset your state of mind. Another key factor is lifestyle. Sleep, nutrition, exercise, relationships, all of these build the foundation of your inner market. If your body is exhausted or your mind cluttered, it will show up in your trading results. And finally, remember that your inner market is dynamic. Just as price action changes day to day, your mental and emotional state also shifts. That's why traders must check in with themselves regularly. A clear, balanced inner market allows you to see the outer market more objectively. Friends, the markets outside will always be uncertain, full of noise, and beyond our control. But the market within us, that inner market, belongs entirely to us. The traders who learn to master this internal space are the ones who eventually master the external one. So the next time you sit in front of your trading screen, don't just analyze the charts, analyze yourself. Because true trading success is not only about predicting what the market will do, it's about understanding what you will do when the market moves. Stay calm, stay aware, and take care of your inner market. Social media and the new investor's dilemma. Let's talk about a modern challenge that's reshaping the world of investing: the influence of social media on new investors. We live in an age where information travels faster than ever. A single tweet, A short TikTok video or a viral Reddit thread can trigger massive movements in the market. For new investors, social media feels like an endless treasure chest of quick tips, stock ideas, and promises of overnight success. But here's the shocking truth. According to a recent study by Fidelity, nearly one-third of new investors rely heavily on social media for financial guidance. And sadly, almost half of them later regret their decisions. Why does this happen? Because social media is designed to capture attention, not to deliver depth. Short clips and catchy headlines can make an investment idea look exciting, urgent, and risk-free. But in reality, trading and investing require patience, analysis, and emotional control, qualities that don't always fit into a 30-second video. Think about it. When you scroll through your feed and see a post with thousands of likes saying, "This stock is going to the moon," it triggers powerful emotions: fear of missing out, excitement, and sometimes even greed. Before you know it, you click buy, not because you studied the company or its financials, but because everyone else seems to be jumping in. And here's the problem. When things go wrong, which they often do, regret hits hard. Investors realize they didn't make an informed decision. They followed the crowd. Fidelity's study shows that many beginners who started this way now look back wishing they had taken more time to learn before acting. This doesn't mean social media is always bad. In fact, platforms can be powerful for learning and community building. Many traders share genuine insights, educational content, and motivational stories. The problem begins when social media becomes your primary decision maker instead of just one of many learning tools. So, how can new investors protect themselves from this trap? The first step is critical thinking. Every time you see a hot stock tip online, pause and ask, what is the source? Is this information backed by facts, or is it just hype? The second step is diversification of knowledge. Don't rely on a single TikTok influencer or Reddit thread. Balance what you see online with trusted financial news, company reports, and your own research. Third, build a habit of long-term perspective. Social media thrives on urgency. Buy now, sell now, act fast. But true wealth in the market is usually created over years, not overnight. When you slow down and think beyond the next 24 hours, you give yourself space to make better decisions. And lastly, always remember that your financial journey is personal. Just because a stranger online claims they made huge profits doesn't mean their strategy will work for you. Everyone has different goals, risk tolerance, and circumstances. What looks like success for someone else might be disaster for you. Friends, social media is not going away. In fact, it will only grow stronger and louder in the years ahead. But as investors, we have a choice. We can either let the noise control us, or we can learn to use it wisely, filtering out the hype and focusing on real knowledge. The next time you come across a flashy video promising quick riches, remember this: the market rewards patience, discipline, and clarity, not impulsive clicks. Your financial future deserves more than a viral post, so stay informed, stay calm, and let social media inspire you, but never let it blindly guide your decisions. The rise of coaching retreats and therapy for retail traders. We're exploring a fascinating shift in the world of retail trading, something beyond charts, indicators, and strategies. I'm talking about the rise of coaching, retreats, and even therapy designed especially for traders. Not too long ago, trading was seen as a lonely pursuit. You sat in front of your computer, stared at screens for hours, and fought your inner battles quietly. But times have changed. As more people step into the markets, they are beginning to realize that trading isn't just about technical skills. It's about mental resilience. And that realization has given birth to an entire industry, now worth over $1 billion. From online coaching programs to luxury retreats in places like Bali, retail traders are investing not just in strategies, but in themselves. Think about that for a moment. The fact that people are willing to spend thousands of dollars, not on a new trading course, but on therapy sessions, brainwave gadgets, meditation classes, and resilience training tells us something important. The mind is finally being recognized as the true trading edge. Why is this happening? Because trading is emotionally exhausting. One day, you feel on top of the world after a big win, and the very next day, a losing trade can crush your confidence. The roller coaster of emotions, fear, greed, regret, and overconfidence takes a toll on mental health. For many traders, this cycle becomes so overwhelming that they either quit or burn out. That's where this new wave of coaching and therapy comes in. Coaches today don't just talk about strategies. They help traders set realistic goals, develop discipline, and create routines that support emotional stability. Retreats, on the other hand, take it to another level. Imagine stepping away from the chaos of screens into a peaceful resort surrounded by nature, where you learn to meditate, manage stress, and reset your mind before returning to the markets. It's like giving your brain a well-deserved reset button. And then there's therapy. More and more traders are seeking professional help from psychologists who specialize in trading behavior. These therapists understand the unique struggles of traders, like dealing with drawdowns, handling the fear of missing out, or recovering from devastating losses. They provide tools to manage anxiety, reframe negative thinking, and rebuild confidence after setbacks. Interestingly, this trend is not just about fixing problems, it's about building long-term resilience. Brainwave gadgets, wellness tools, and mindfulness apps are being marketed to traders as ways to stay sharp, focused, and emotionally balanced. Some may dismiss these as luxuries, but for many, they become the difference between survival and burnout in the market. But here's the bigger lesson for all of us. You don't need to fly to Bali or buy an expensive gadget to take care of your trading psychology. What this movement really teaches us is that self-care is not optional, it's essential. Simple practices like journaling your trades, taking regular breaks, meditating for a few minutes, or even just making sure you get proper sleep can dramatically improve your performance. Friends, this rise of retreats, coaching, and therapy highlights a powerful truth. The markets may test your strategies, but they also test your mental strength. And those who invest in strengthening their inner world often find more consistency in their outer results. So the next time you think about upgrading your trading skills, ask yourself, are you only upgrading your charts and tools, or are you also upgrading your mind? Because in the long run, it's not just the smartest traders who survive. It's the strongest, the most resilient, and the ones who know how to take care of themselves. The new generation of buy-the-dip investors. If you've been around the markets long enough, you know that downturns often trigger panic. When prices fall, many investors rush to sell, protecting themselves from further losses. But today's new generation of investors sees it differently. For them, a dip isn't a warning sign. It's an opportunity. They've developed a bold mindset. Whenever the market pulls back, it's time to buy. Now, what's fueling this confidence? Unlike older generations who lived through painful recessions or devastating crashes, many younger investors haven't faced those extreme downturns. Their primary experience of the market has been shaped by resilience, periods where stocks fell sharply but then bounced back even stronger. Whether it was during the pandemic crash of 2020 or smaller pullbacks since, they've seen the S&P 500 and other major indices recover quickly. For them, dips don't signal danger. They signal discounts. This behavior has had a surprising effect. Every time markets stumble, waves of young retail investors step in, pouring their savings into stocks, ETFs, and even cryptocurrencies. And in doing so, they're not just investing, they're actively helping the market rebound. Their participation has become a hidden force behind the resilience of today's market. But here's where it gets interesting. The buy-the-dip strategy feels empowering. It makes investors believe they're smarter than fear, braver than panic. Yet, it's also risky, because markets don't always bounce back quickly. History shows us that there are times when dips turn into deep, prolonged downturns. Think of the dot-com crash in 2000 or the financial crisis in 2008. Those who bought every dip back then often had to wait years, sometimes a decade, just to break even. So while this new generation has given the market strength and optimism, the question is, are they prepared for the day when the dip doesn't bounce? This is where trading psychology becomes crucial. Buying dips requires not only courage, but also patience, discipline, and risk management. A dip can be a gift, but only if you're prepared for the possibility that it could get deeper before it recovers. Without that mental resilience, dip buying can turn from confidence into recklessness. Think about it this way. If you buy a stock at a discount and it keeps falling, will you stay calm and hold your plan, or will you panic and sell at the bottom? The answer depends not on the chart, but on your mindset. And that's why self-awareness is so important. For young investors listening right now, here's a takeaway. Optimism is powerful, but don't let it blind you. Use the buy the dip strategy wisely. Instead of putting everything into one fall, consider gradual entries. Buying small portions as the market drops, so you spread your risk. Diversify your portfolio so that one wrong bet doesn't shake your confidence. And most importantly, remember that dips can last longer than you expect. Be mentally prepared for patience, not just quick rebounds. Friends, what's truly inspiring about this generation is their refusal to fear the market. They bring energy, resilience, and optimism that fuels the system. But lasting success in trading comes not just from bravery, it comes from balance. Balancing optimism with caution, bravery with discipline, and action with patience. So yes, buy the dip if that's your strategy, but buy it with wisdom, with preparation, and with the emotional strength to hold on when the dip goes deeper than you imagined. Because in the end, the greatest dip you need to master is not in the market, it's in your own emotions when prices fall. Stay steady, stay strong, and let every dip teach you more about yourself than the market. Comparison, FOMO, and the hidden impact of social trading platforms. We're exploring one of the biggest psychological traps in modern trading, the influence of social comparison and FOMO that comes from social trading platforms. Over the past few years, platforms that allow traders to share results, copy strategies, and display leaderboards have exploded in popularity. At first glance, it seems like a brilliant idea. You get to see what other traders are doing, learn from their successes, and even copy the moves of top performers. But here's the hidden truth. According to a study by Investopedia, this constant comparison often fuels FOMO, fear of missing out, which leads to impulsive trading decisions and unnecessary portfolio volatility. Let's break this down. Imagine logging into a platform and seeing a leaderboard filled with traders boasting massive returns. One person claims they doubled their money last month. Another shows off screenshots of winning 10 trades in a row. Suddenly, your own progress feels small, maybe even insignificant. That's when FOMO kicks in. You start thinking, if they can do it, why not me? Maybe I should take bigger risks. Maybe I'm being too cautious. And that's where the danger lies. Instead of following your plan, you start chasing trades, copying others without fully understanding their strategy, or jumping into risky positions just to catch up. Slowly, your decisions stop being about your own goals and start being about keeping up with strangers on a screen. This comparison-driven mindset is dangerous because it pulls you away from rational trading. You may end up overtrading, risking too much, or abandoning strategies that actually suit your style. And when losses hit, as they inevitably do, the emotional pain feels even sharper because you believe you're falling behind. Experts say the solution is simple but powerful. Focus on your own journey. The truth is, trading is deeply personal. Your goals, risk tolerance, time horizon, and financial situation are unique to you. Comparing yourself to others is like comparing a sprinter to a marathon runner. They're running different races altogether. Here's a helpful perspective. Next time you see someone posting extraordinary returns online, remind yourself, you're only seeing the highlight reel, not the full story. You don't know how much risk they took, how much they lost in the past, or whether their luck will last. Just as on social media, where people share their best moments, trading platforms also encourage people to showcase only their successes. So instead of chasing someone else's path, build your own. Define clear personal goals. Are you trading for consistent monthly income? Are you investing for long-term growth? Are you practicing to build skill over time? Once your goals are clear, measuring your progress becomes easier and more meaningful. Another way to fight FOMO is to practice gratitude. Yes, gratitude. When you focus on the progress you've already made, no matter how small, you shift your mindset from scarcity to abundance. Instead of thinking, I missed out on that trade, you begin thinking, I'm proud of the discipline I showed today by sticking to my plan. That shift in thinking is what separates reckless traders from resilient ones. Friends, the truth is, FOMO will always exist. Markets move fast, opportunities appear and vanish, and someone somewhere will always seem to be making more money than you. But trading success is not about racing others. It's about mastering yourself. So, the next time you log into a social trading platform and feel the pressure to copy or compete, take a deep breath. Step back. Ask yourself, am I making this decision because it's right for me, or because I'm afraid of being left behind? Remember, discipline beats comparison, and patience beats FOMO. The only trader you need to outperform is the version of yourself from yesterday. That brings us to the end of today's journey into trading psychology and the hidden forces shaping investor behavior. I hope these insights gave you a new perspective on how mindset and emotions influence the market, often even more than the numbers on the screen. Remember, trading isn't just about strategies, it's about understanding yourself, staying disciplined, and keeping focus on your own goals rather than getting lost in comparison or noise. If you found this helpful, make sure to like, share, and subscribe so you don't miss out on more powerful lessons in trading and investing. Thank you for listening, and I'll see you in the next one.